I would like to remind you that I am not a financial advisor. Anything I say here is for education and entertainment purposes only. You can and will lose money if you don't do your own research. Support and resistance. What is it and how is it used? Support and resistance levels and zones are locations on a chart where excess supply or demand can be found based on historical price action data, convergence with indicators, or psychological levels. These levels could be used to identify a reversal of a trend and potential entry and exit points. Trendlines are popular tools used to identify and map out support and resistance levels among traders. A trendline is a line that is drawn across a chart and it touches at the minimum 2 or 3 pivot point zones. A pivot point zone is an area where price changes direction on the chart. The more pivot points that meet the trendline, the stronger the trendline is believed to be. A trendline can be both diagonal and horizontal. Horizontal trendlines are commonly known as static trendlines. Diagonals are commonly referred to as dynamic trendlines. Support is confirmed when price going down pivots up after reaching the projected trendline zone. Resistance is confirmed when price going up pivots downward after reaching the trendline zone. A trendline becomes support when price breaks through the trendline and pulls back to the trendline zone and then pivots back to the upside. Support lines become resistance when the opposite happens. Price breaks below the trendline and then pulls back up, touches it, and pivots back to the downside. Indicators such as moving averages can also act as support and resistance levels. For example, here we can see that after the 2020 sickness crash, the SPY bounced off the 50 EMA or the 100 SMA for a period of approximately 18 months. But once price moved significantly below these moving averages, they began to act as resistance. Some traders will use Fibonacci levels to map out support and resistance levels. For example, here we can see that Apple began to have a pullback at the 61.8 Fibonacci level and acted as a level of support, and that the 100% level acted as resistance, but once it broke above that level, it acted as support. Psychological price points such as whole round numbers are also used by many traders to begin or exit a trade. For example, we can see here that AMD stock had support and resistance levels at the $75, $100, and $125 price points. Different traders use different indicators in their strategies to map out support and resistance zones. Their buy or sell triggers might be different from each other. But when more than one method of support or resistance levels converge, you can have what some call super support or resistance zones. This could lead to more traders buying or selling at these convergence points because all those indicators from different strategies could signal a buy or sell for their strategy. This could lead to higher probabilities of being correct in an analysis. It is important to note that not all support or resistance levels will hold every time. As a trader, it is important to look beyond just support and resistance levels or zones. Volume, market direction, sentiment, earnings, macro, and micro events can help price push through a support or resistance zone. It is important to fully evaluate and weigh out the potential risk and probabilities of a strategy when using support and resistance levels to enter or exit a trade. If you found this information helpful and would like to see more videos like this or get notified when I release a new video, click the like, subscribe, and notification buttons. Leave a comment below if you would like to see videos on a specific topic. Thank you for watching and have a great trading week.